Alrighty, here we go. Chapter 6, 7, and 8 review. Here's a very quick how-to. I think everybody has the first few entries of the sales, okay? Here's where they buy it or sell it. Here's where they record how much it costs them for their inventory. This is the sales return. And this is how much the sales return put back into inventory. I think everybody got that fairly well. It's when they went to pay this thing off or to receive the cash, whatever. They had a $3,000 invoice. $500 was returned. That means the company owes them $2,500. So they have it with a discount, and the discount is 2%. Now that you have things set up, all you have to do is multiply things up. And I've given you a check figure. The sales discount is $50. Okay, so that goes there. The accounts receivable is $2,500. What does that make the cash? Now, if you're really on top of this, this is the purchase side. And if you come over here and check this cash figure, whatever they paid is what these folks received. So here is the discount that comes out, and their accounts payable should match the accounts receivable. So play with that a bit. On the inventory, most people got this. The check figures helped, but here's how I'll get you started on it. You had 10 at 25, so you have $250. You bought 25 more, so that gives you 35 in stock now. They cost $30 each. So I'm adding $750 to the inventory. So these are my units, and this is my dollars. I now have $1,000 in inventory and 35 pieces. So if I divide 35 into 1,000, I come up with $28.57 as the inventory balance. Now, I'm going to sell 11 of them at $28.57, and this is my cost of goods going out. I'm going to subtract the 11 from the 35 and come up with 24, multiply that by 28.57 and come up with 687. And you just continue doing that on down the line, and you should come up with 704 in inventory when you're done. Retail method. Okay, I think this is the biggie. You add these two and these, and you come up with 60,000 and 140,000. You want to know what percent the cost is of the retail. So you divide 60,000 by 140 and come up with 43%. Now you have a net sales of 75,000, so this has to be subtracted from the 140. Whatever that comes up to is then multiplied by 43%, and that becomes your inventory at cost. The reconciliation is just like the one that was in the other review or one of the homework problems, so look that up and see how it works. Petty cash. This one, I kind of gave you all the numbers. First of all, I said the check figure for replenishing was $200. That's how much you're going to credit your cash. The over and under was 15. I didn't tell you which it was, but if you added your expenses here, you found out the over and under was actually over. So they had to do $200, and then they had these expenses, and they balanced it with the over under at $15. Depletion, you had a cost of $25 million, no salvage. That gave you $25 million divided by 40 million gallons of, must be oil at this time. So how much did each gallon cost? So you divide the 25 million by the 40 million, come up with a cost. Here's your check figure, 63. How much did they take out? 3.6 million. So if I multiply that times 63, I come up with the depletion cost. That's a cost. just like depreciation cost. So then whatever this number is, you use the depreciation expense and accumulated depreciation. Book value. Now this one, I can't believe you didn't get this one. Maybe I can. There's a couple of steps here. So now I got to figure out, and I give you these check figures here. Okay. You have to figure out the depreciation expense. And I must have this set to, I do. So, straight line. Here's your information. You had 250,000 with a salvage of 10,000. That leaves you a base of 240,000 divided by 5 gives you the depreciation per year. You take that depreciation, you slap it in here, and it should give you this should become 202. Actually, I just need to take that out so you're not mistaken. And that's my puppy talking to me. So if you subtract that depreciation expense from the cost, you'll end up with the book value, and it should match the check number. Same thing with units of production. Okay, just calculate it out. You come up with a useful service, divide that into the base, you'll come up with the per hour. Multiply it times the hours used, it comes up with the depreciation. With your other, you're double declining. Straight line is 20%. If you're double declining, you'll do straight line times 2, so that's 40%. Multiply that times the 250. You'll come up with your depreciation expense. Put it in here and come up with the book value. So that one should be fairly easy for you. This one is depreciation of everything. So again, cost minus residual gives me base divided by operating life gives me depreciation per hour. And I give you a check figure for that. They ran 225 hours times that depreciation cost gives you the monthly depreciation cost. That was units of production. Now, we're going to do straight line. And you know how to do straight line. 210 minus 15 gives you the base divided by 5 gives you depreciation per year. And I'm just asking you per year, what is the book value at the end of 3 years? Well, 39,000 times 3 minus subtracted from 210 is going to give you the book value. And here's double declining. This one, 1/5 at 20, and you want double declining, so that's 40%. We start with 210, the full value, times 40, gives us annual depreciation of 84,000. We have accumulated depreciation of 84,000. We take the accumulated depreciation, subtract it from the book value to come up with the new book value right here. This gets transferred here, and you start all over again. You'll add the annual depreciation to this depreciation to come up with the total accumulated depreciation. You take this, subtract it from here to get the new book value and bring that number down to here. And finally, the sale. And you kind of do the whole thing all over again. This is straight line. You go to depreciation for 3 years to get the accumulated depreciation. And they sell it for $100,000. Well, you already have some numbers you know. First of all, you know cash, you're going to receive $100,000. And you're going to have to remove that 160 out of the equipment because you sold it. This is your check figure. Accumulated depreciation is always debited when you're doing a sale. What's the difference? Is it a credit or is it a debit? These here must match. And that is the Chapter 6, 7, and 8 review in a nutshell. Hope it helps.